All right, welcome back to round number 3 of your simulation. So this year was a tricky year because you had this executive dilemma to deal with. And basically the situation was that when customers give you out the information, they expect you to keep it private. But you're approached by the Australian Securities Intelligence Organisation and they wanted you to grant them unrestricted access to a lot of the customer data that you had, with the argument that it might actually prevent a future terrorist activity or it might shut down some drug trafficking operations. So, what would you do? The first option was to prevent access to honor the commitments that you made to customers. The second option was to allow them to look at the data, and it would actually mean that you could change your data policies and customers would might lose customer trust. Or the third option was to maybe just allow them to save lives, but you also secretly provide them with the data and hope that customers don't find out. So the reason why we're doing this is because what you're going to realize in your careers. So in university, a lot of the time, the questions that you face, there's a right or a wrong answer. In the real world, there's a lot of ambiguity because you're dealing with a lot of stakeholders and a lot of different stakeholder interests. And you're thinking about impact short term, long term across different measures, different areas in your bank. And this grayness, managing that ambiguity is really important and it's something that really differentiates really successful people in their careers. So that's what this was really all about. So we had 5 of the 7 banks in the market choosing to prevent access, one of you allowing access, and one of you providing with the covert data operations. So let's have a look at how this actually played out. So if you were to prevent access, that would mean that you get to honor the commitments to customers, keep the data private, which maintains their trust. But other banks that have gone on to support show that they've gone and made that commitment publicly. So what that means is that your bank has some implication here from the media around being difficult and not saving lives. The second option here around allowing access was that you allowed access, but uh, a change to your data policies might actually lose customer trust. And the media shows your bank to be saving lives and doing the right thing for the wider community, but there is that trust element to balance off too. And then the third option here was around covert data. So you want to save lives, but you also want to honor the customer commitment. So you secretly provide the data. There was always the risk this would be leaked, and that is exactly what happened. And so customers are upset, and the press also shows your bank to be dishonest. So this is a little bit of a flavor as to what you need to think about in the real world. There's a lot of decisions like this, and this one has some financial and non-financial impacts. We've actually reduced all the impacts for you, for your banks, so you don't need to actually do any of this, as in it's not going to have any implications on your performance. But what we want you to think about is in the real world, when you start to take your graduate jobs, start thinking about the breadth of stakeholders that are impacted. Start really thinking about driving these robust decisions. That's a skill that's really going to hold you in good stead throughout your whole career. It's something that senior management, senior executives struggle with, and it's something they spend a lot of their days dealing with, right? These ambiguous decisions. So it tends to be less black and white. A lot of the black and white stuff is really well taken care of, but these sorts of issues are the things that really cause banks a lot of grief and take up a lot of time, effort, and money. Okay, this year it was actually a tough year because we saw home loans only growing at 1%, business loans went down 3%, deposits grew at 8%, and credit cards went down by 9.8%. So the reason deposits grew by 8 was because we're in the middle of a downturn. So there's a bit of a flight to quality. People are a little bit worried and they're moving their money into the safety of bank deposits. This is what happened actually during the global financial crisis here in Australia. A lot of the regional banks, so the Bendigo Bank, Adelaide Bank, there was Bank of Queensland, some of those banks out there, there was some questions around whether or not they were solvent. And a lot of the mums and dads who left their money in those banks were nervous and they pulled them out and they moved them into the safety of the big 4 banks. And the regulators had to step in with a government guarantee. So that is basically a guarantee that says if you have up to $250,000 in any given Australian or authorised deposit taking institution or an ADI, that money is guaranteed by the government. Anything over 250 is not. Let's talk about those losses. Remember, this is credit losses. Home loans are 8 to 30 basis points. They started off at 2 to 3. Business loans are 5 to 640. Now they started off, I think, at 3 to 1 point or 3 to 80. And then credit cards, they're at 3.75. They start off at 2.5. So you're starting to see the impact of the credit piece here. So these losses, they take a long time to materialize, but generally, poor lending decisions really show in times of uncertainty. And I know you covered credit risk, I think in week number 7. So remember, there's individual credit risk and then there's also portfolio level credit risk. We'll talk about both of those elements in a moment. All right, margins. This year you had a cash rate cut to contend with. So the Reserve Bank of Australia reduced the official cash rate by 25 basis points. So what that generally does is that means that that impacts the short-term interest rates in the market. So that's basically overnight money. And it sends a signal across the yield curve, really. So if we do nothing in our bank, what's going to happen here is the benchmark rate for wholesale funding will fall because that's probably linked to that, it's closely linked to that 90-day bank bill swap rate. So what that means is that our margins will probably expand, but we have a question here around the lending side of things. Do we keep the prices high for our home loans and our business lending customers? That's the question. Now this relates to something you talked about in weeks number 2 and 3, I think, around when you're talking about repricing risk. And remember you talked about interest rate sensitive assets and rate sensitive liabilities. And then remember there's going to be interest rate insensitive elements around those too. So banks find it really hard to maintain margins in a falling cash rate environment. The reason is because there's a lot of interest rate insensitive deposits. So these are often transaction deposits. So these are the kinds of deposits that you might use to make your tap and pay, tap and go transactions, just to pay for things generally. The interest rate on those is basically zero. You don't earn very much at all. So as the official cash rate falls, and banks may be charged less on their home loans and business loans, when they go to the deposit side of things, there's an element of deposits which are rate sensitive, and they're going to be the savings accounts, but there's an element which are interest rate insensitive, and you can't reduce them anymore. And so therefore, you're not able to reduce your funding costs as quickly as what the interest rate on your lending products falls, which is why margins generally fall for banks in a falling cash rate environment. But the same or the opposite is true in a rising rate environment, which is where we're at now, in that bank margins actually expand in a rising rate environment. So your black line at the top only fell by 8 basis points. Your cost of funds went up by 1, which is why your overall margins reduced by 8. In terms of individual banks here, 3 banks were able to expand their margins: UN, PB, Levitate, and Unibank. The rest of you actually saw margin compression this year. UNPB, the highest margins overall for everyone. Okay, now you covered in one of your earlier lectures, I think week 5, you talked about credit risk. We spoke about there's an individual component and there's a portfolio level component too. What you can see in this chart here is your business lending loan losses. Now you'll notice that these losses have spiked up from about 150 to 200 million in year 1, all the way up to between 600 to 1.4 billion. Some of you tightened your lending criteria in the middle of the last round, in the middle of the crisis. But just because you tighten your lending criteria in a downturn doesn't cleanse your bank of customers that have previously been originated at different credit qualities in earlier years. So that's why these losses have all increased. The other thing here is, remember, when you're thinking about the product in itself, so this is a portfolio consideration, business loans have variability in terms of their losses, and there's an element which is cyclical here. So banks very exposed to the economic environment, and what's going to happen is often as the economy deteriorates, banks' loan losses will increase. But that's why banks often take what's called a through the cycle view around credit risk, and they won't price loans based on the prevailing economic conditions. Rather, they'll almost take a long run average view, and they'll look at what the credit risk might look like in a more normalized period, and then they'll apply that when they're thinking about pricing loans. But there's also those things like those RAROC models that you talked about earlier. And remember, that's going to have a look at what's going to be my profit after my capital really, after I've considered the capital implications. So the capital has a risk element in that too, but remember also when banks are thinking about the loss element here, they're also probably basing that loss not just on what the current losses are, but they tend to take what's called an expected loss or a long run view of those losses. So they don't basically look at the losses right now. They might look at it and say, what's the average losses look like over a number of years through a full economic cycle. Sometimes when banks get this stuff wrong, this costs them billions of dollars. So we're not saying that banks should really try to eliminate losses from their business because losses are part and parcel of banking. But they want to make sure they've priced appropriately for those losses. And when those losses do appear, they're not a huge surprise for them. It doesn't erode their capital base. It doesn't cause them to be in a pretty terrible predicament. All right, let's talk a little bit about bailouts. We had one, two, three, four, five banks being bailed out this year. NC Bank, a small bailout of 16. Unibank, 27. Goldman's, 32. But Tells, 52. And then Levitate, 114. I'm just going to show Levitate here just to help you out a little bit. Levitate, here's your balance sheet in round, this is a treasury in round number 3. So what you'll notice here is that you were assuming 2% asset growth and you're assuming 9% deposit growth. That's fine, but if you have a look at this forecast assets and funding position, your yellow bar, which is all the loans that you're lending out, significantly exceeds how much funding you've got. So you need to make sure you have funding to support this lending. So what you want to make sure you do is you raise wholesale funding, and you need to raise enough wholesale funding that you've potentially got all the way up to, you might need a lot. You might actually exceed the cap, but you need to make sure you keep raising wholesale funding every year. Otherwise, you're going to have this big mismatch, and that's why your bank is struggling in terms of wholesale funding. For Tells, it's probably a different story. As you can see here, you assumed you were going to have cash of $2 billion. Okay, that's your liquidity buffer. Remember, banks always hold extra cash or liquidity in case these depositors want their money. You're assuming 50% deposit growth in a market where deposits are growing 7 to 9%. So what are you doing to really incentivize so much growth in your deposits? I think that you'll find your pricing is very much in line with everyone else. So if these deposits don't come in at 50%, if they only come in at maybe even 48%, have you noticed how you don't have any more cash? You've got no buffer. So that's why you suffered this particular year. Okay, so just bear that in mind when we get back into the next year. All right, wholesale funding issues. As you can see here, these wholesale funding issues is very, very large. So Levitate 8.65%, almost $120 billion. Tell 7.4%, NC Bank 5.98. I think what you'll find is the cost of these issues are so expensive that if you're using these new issues and you're lending them out to your home loan customers, the cost of the issue would exceed how much you're earning, meaning you're writing negative margin loans. Okay, and that's actually flowing into profitability. So you can see Levitate and Tells on the left, on the right hand side, both negative, but UNPB, that's a very healthy profit in the middle of a crisis, 3.3 billion, and Group 7, even though your profit's 2.8, if you look at your return on equity, 19.9, that's an excellent return on equity. So well done. This is a big driver, obviously, and you want to make sure that you continue to generate stable profits because you can reinvest into your business. And it also means you're going to pay high dividends to your shareholders. All right, customer satisfaction. This is 40% of your overall score. Everyone has higher scores than what they started with, but Levitate, the customers do love you. You're firing away 3 from 3 in first. Then we've got Unibank. Then we've got Group 7. All right, what about shareholder returns? Shareholder returns, look, this is a very close race. We actually have, I think, an equal first here. UNPB, Group 7, and NC Bank, number 23, in third place, but UNPB and Group 7 tied for first place. Very, very close though. Goldman's are sitting there in fourth place and a nice upward trajectory from Unibank. All right, so when we put it all together at the end of round number 3, we have in first place, Group 7, you're still there. We've got an equal second here between UNBP and NC Bank 23, and they're not too far behind Unibank as well. All right, this year you've got the ability to acquire another business. So there's a regional bank up for sale. You could inject stability and leadership to strengthen their performance. You're only buying 45% of them, so have a think about the appropriate level of investment return you would need to buy something like this and the expected amount of synergies. The concept is exactly the same as what you did in terms of round number two, so the way in which you priced up that previous neobank. And then in another executive forum, this one will have some decision or impact on your overall bank. So think carefully, and maybe when you do your write-ups, your weekly write-ups, write a couple of points as to the option you chose and why you actually chose that. Okay, this year, if you're a CEO, please make sure you pass the baton to somebody else. Click appoint new CEO. That person will choose who you want to promote, and that person will get a pop-up box saying, do you want to accept your promotion? And please say yes. All right, round number 4 of your economic environment. Where are we headed? Well, there is a bit of a recovery, so you're moving forward, but carefully. So the economy is recovering. Debt and equity investors still a little bit nervous, and what you'll find is that credit spreads reflect this. But default rates are easing, which means those losses are going backwards, and lending growth is positive. No change to the cash rate, no change to the bank bill swap rate this year. Wholesale funding costs have come down. They're not as good as what they were in round 1, but they're not as bad as round number 3. All right, this year is your final year. And you might be thinking, well, it's only year number 4, so what we're going to do last year, we are going to increase our rates. We're going to make a lot of money, and that's the end of the game. Well, the truth is that your banks are actually going to be continued to run for another 4 years. So one thing we actually, or 5 years, excuse me, one thing Accelerate Consulting that we want to promote is good long-term sustainable decision making. So if you leave your bank in a good position at the end of this year, that's going to continue on. And if you leave it a little bit of a dumpster fire, that'll hurt you. So what happens after this year? Well, all pricing decisions revert back to the average. So the reason why is because price is not a sustainable competitive advantage. Okay, it can be easily copied by anyone. Treasury will be managed optimally for you. We're going to have you at an A credit rating. We'll make sure you've got ample funding and liquidity. Secondary levers will go back to their beginning settings. That is with the exception of the branch network. So the question is, what do I do to differentiate my bank? So the first thing is the branch network. Wherever you leave that will continue in years 5 to 10. Change initiatives. Some change initiatives are going to have longer term benefits, and those benefits will continue to drive momentum for your bank. Non-financial transformation. So that customer satisfaction, wherever you can get that to, will continue to have impact on your bank, and then the deal's done. Okay, so good luck in round number 4. As always, please don't hesitate to contact us, but all the best in your final year, and we will speak to you shortly.